Well, greetings everyone and welcome to the Argonaut monthly video covering May 2025 and the first week of June. While we've seen a continuation in the rally in risk assets since the initial panic over trade tariffs on Liberation Day, during May, President Trump agreed to a 90-day reduction in tariffs on China from 145% to 10%, announced 50% tariffs on the EU, only to agree to delay them for 6 weeks, whilst the UK signed a deal agreeing to 10% US tariffs with none for US imports into the UK. We also saw the passing of the Big Beautiful Bill through Congress, which prioritises tax cuts over spending increases, and if it comes into law in its current form, will largely repeal Biden's renewable energy tax credits and subsidies. You can read our thoughts on this and the performance of the two Argonaut funds in May in our monthly commentaries. But in this month's video, we are going to focus on Eastern Europe, where the funds have some significant investments. During the month, we travelled there to meet with these companies. We are also going to compare Eastern Europe to Western Europe, and in particular Germany, where there's been a lot of recent market excitement over fiscal stimulus and rearmament. Let's start by looking at Germany. Where did it all go wrong? Successive German governments have fatally undermined its manufacturing base through successive acts of economic euthanasia. Switching off its nuclear power reactors, even after the outbreak of the Ukraine war, with the final 3 being shut in March 2023, over a year later. Becoming hooked on geopolitically unacceptable Russian gas. Remember, Nord Stream was blown up in August 2022, so Germany kept importing Russian gas for 6 months after the war started. Increased reliance on expensive and unreliable wind and solar, 45% share that require subsidies where the costs of intermittency are met by the consumer, so that along with the UK, which is not so reliant on industry, Germany now has the highest electricity prices in the world, which isn't great when you're a manufacturer. Germany also went along with the EU banning new domestic sales of internal combustion engine cars by 2025, where Germany is world leader, and instead decided to subsidize sales of electric cars where the know-how is in the batteries and the Chinese seemingly have an unassailable lead. Its corporate sector has also unwittingly transferred its manufacturing know-how to its main mercantilist competitor in China, and even today is so concerned about access to past Chinese export growth markets that it fails to see that unrestricted Chinese imports into the EU are undermining its economic and geopolitical power. Now, when a new German coalition government formed out of elections in February, but using votes from the previous parliament with deputies who had been voted out of office, approved amendments to Germany's basic constitutional law with exemptions from its constitutional debt brake in fiscal prudence, Germany passed a fiscal bill package of over 1 trillion euros to be spent over 10 years, so 2% of GDP per annum, including both increases in defence expenditure, but also 500 billion or half for an infrastructure fund. Now, since the German debt to GDP ratio is relatively prudent at 65%, many European investors have greeted this relaxation of Germany's debt brake as a kind of magic money tree solution to the problem of European economic sclerosis. If only those prudent Germans would have thought about borrowing more money earlier. Alternatively, it is like a bankrupt drunk suddenly finding some cash down the back of the sofa. We do not believe that Europe's economic problems, largely created by too much government, can be solved by allocating more capital to government to spend. Rather, they need lower taxes, they need to cut subsidies and regulations, and they really need to get rid of net zero. So the basic problem with the EU's attitude to the economy had already been summed up by Ronald Reagan in 1986.
If it moves, tax it. If it keeps moving, regulate it. And if it stops moving, subsidize it.
Contrast this with Eastern Europe. Having experienced 45 years of communism, Eastern Europeans are generally more capitalist in attitude, with comparable skills in education. And compared with Western Europe, their economies are faster growing, their public and private debt levels are much lower, and they have much lower personal and corporate tax rates. And they generally don't sign up to the usual EU humbug on climate change or unrestricted immigration, all of which means their economies and societies work better. Let's now compare Germany to Hungary on competitiveness for manufacturing. German domestic electricity prices for large consumers, including taxes, are currently 30 pence per kilowatt hour. This compares with 10 pence per kilowatt hour in Hungary. So Hungarian electricity prices are a third of the cost in Germany. Let's now look at taxes. Corporate tax is 29.9% in Germany, but only 9% in Hungary. The top rate of personal tax is 47.5% in Germany, compared to just 15% in Hungary. If you are building a factory today, you would be mad not to build it in Hungary instead of Germany and still gain access to the same EU markets. Our largest position in the funds is currently Hungarian bank OTP, which is also exposed to Bulgaria, Slovenia, Serbia, Croatia, Montenegro, Uzbekistan, as well as Russia and Ukraine. Now, I first invested in OTP in 2002, so this is not my first Hungarian rodeo. Since it listed in 1995, the company has seen impressive compound annual growth of 15% in performing loans, 18% in earnings per share, and 21% in share price performance. Since IPO, management has reduced its cost-income ratio from 74% to 40%, whilst never raising additional equity from either capital markets nor governments, nor has it overpaid for bolt-on acquisitions, with return on equity averaging 21% since 1995. This year, the bank aims to exceed last year's loan growth of 9%. Compare this with Western Europe, where loan growth is almost non-existent. Net interest margins are 420 basis points, so a lot higher than in Western Europe. But cost of risk is still fairly prudent at just 40 basis points, with a highly profitable ROE of over 20%, low leverage of just 10 times, and abundant capital with a TER ratio of 18%. Yet the bank trades at just 6 times earnings or 1.5 times book value. This looks very cheap to us. So the immediate blue sky scenario for OTP would be an end to the conflict in Ukraine, which would reduce political risk and inflation in Eastern Europe in general. But since OTP owns one of just a few well-capitalized banks in Ukraine and is used to the habitual challenges of doing business there, OTP's bank would see significant capital flows focused on reconstruction. If it doesn't happen, we still are investors in a very cheap bank that will grow a lot faster and a lot more profitable than peers elsewhere in Europe. Now, hopes for a ceasefire in Ukraine continue to be dashed by maximalist Russian demands. And it's easy to see why mainstream opinion still believes that an end to the Ukrainian conflict is unlikely and views Putin's decision-making as purely pathological. But Russia has now lost over 1 million troops in Ukraine, and compare that to just 15,000 in the unpopular Afghan war of 1979 to 89. And Russia has just taken 20% of Ukrainian territory in over 3 years of war. At its current rate of progress, according to the Institute of Study for War, it would take Russia another 4 years to conquer the 4 regions it claims to have annexed, and nearly a century to seize all of Ukraine at the cost of nearly 50 million casualties. In other words, the conflict is a stalemate. We also have some skepticism about whether Russia's economy can continue to finance the war indefinitely. Russia's official defense budget is supposed to be $150 billion, or 7% of GDP, opposed to Ukraine's at $65 billion, or 34% of Ukraine's GDP, which has been supplemented by $130 billion of US and European military aid since the conflict started, and $350 billion of total aid, including financial aid in total. However, the economic resources Russia is expending in the war seem to have been underestimated in our view. Since mid-2022, there has been a $400 billion, or 20% of GDP surge in Russian corporate borrowing, predominantly consisting of government-induced compulsory loans to defense contractors, more than doubling Russia's official annual defense spend, much of which must be considered doubtful of ever being repaid. So in other words, Russia has been spending a lot more on its defense budget than officially recognized, perhaps up to 16% of GDP rather than 7%. Now, although the Russian government debt to GDP is relatively modest at 20%, its sovereign wealth of $300 billion, or 15% of GDP, representing half of its central bank assets, remains frozen in the West, whilst its government will eventually need to recapitalize its state banks and perhaps other corporates like Gazprom. Saudi Arabia, in contrast to policy under the Biden administration, is also increasing oil production to regain market share, which will continue to cap the oil price and put pressure on the Russian economy. So despite its bluster, we think that Russia cannot continue to wage a forever war. Now, European NATO members have recently proposed a 3.5% target of defence spend as a proportion of GDP as the new 2% NATO target, plus another 1.5% on infrastructure, which always seems to me like a pork barrel. This month, Germany sent 5,000 troops to Lithuania and has committed to increase spending on defence to 5% of GDP, or around 200 billion euros per annum, from 2% or 40 billion euros today. Hence why Rheinmetall, the German weaponsmith, is up another 200% this year and up 900% since we bought it in 2022. When, as in Operation Spiderweb, on June the 1st, $1,000 worth of Ukrainian drones costing $5 million in aggregate can destroy $2 to $7 billion of Russian aircraft hardware, then the more important question for defence spending is whether money is being spent in a cost-effective way. The £9 billion the UK wasted on 2 Elizabeth-class aircraft carriers being a case in point. Future defence spending is likely to focus on drones, submarines that cannot be seen from space which can see everything else, and munitions rather than hardware. Our observation is that the market is not currently distinguishing between defence companies, but instead buying them on a macro theme basket. The delivery of this spend is somewhat dependent on Russia continuing to be seen as the bogeyman rather than as a straw man, which might be more accurate.